Consensus Hong Kong 2025 is where the global crypto community converges to shape the next era of Web3. From February 18th through the 20th, Hong Kong becomes the meeting point for leaders across finance, technology, and digital assets. This isn't just a conference, it's where deals are made, partnerships are forged, and new opportunities emerge. Consensus features exclusive networking lounges, expert-led sessions, and invaluable insights from top industry voices. Whether you're expanding your network, building your brand, or closing your next big deal, this is the event that moves markets. Visit CoinDesk.com/consensus-HK to secure your spot and use RealVision15 for 15% off. Don't miss your chance to be part of the industry's defining moment.
Hey everyone, sorry to interrupt, but this is the cheesy podcast bit that gets on everyone's nerves, but it's really important to me. Please, if you can like the channel and also subscribe, it helps me a lot to get the best guests in the world for you guys. So click like and subscribe. Appreciate it. Thanks.
Hi, I'm Raoul Pal, and welcome to my show, The Journeyman, where we explore that nexus of understanding between macro, crypto, and the exponential age of technology. Now, it's quite funny me saying that because when I first started this show, I think everyone was like, what the hell is crypto, macro, and technology all in the same show or that same journey? And I think you're now learning it is all the same thing, where all of these worlds are all colliding into something dramatically powerful and ever-changing. And that was the whole purpose of this. And we keep moving that forwards in all sorts of incredible ways with all sorts of incredible guests. Now, the big one for many of us is the crypto journey. The crypto journey is the bet that we've taken, the way that we're trying to change our lives to unfuck our futures. And I always try and bring along people who are really thoughtful, interesting, and particularly people who have money on the line. You see, there's many voices in the space. In fact, it's overcrowded by voices in crypto. And I like to get to the source of the people whose job it is to invest in crypto. And that's the hedge fund managers. I have my own asset management firm, Exponential Age Asset Management, XPAM, where we actually just invest in the world's best hedge fund managers within crypto. So within that, I get to meet many of them. And Joe McCann is one of those. Joe McCann is well known on Twitter, but he's also, beyond his Twitter personality, he's also a very good investor. He has a unique eye for the space. He has an understanding of the macro, the technology, and the crypto that gives you an advantage. And I like to sit down with Joe every 6 months or so and just shoot the shit. Figure out what he's looking at, how he's seeing the world, how I might differ, where we might see the same thing, and try and figure it out together. So I'm really excited to bring you this conversation to help you figure it all out with Joe McCann. Enjoy.
Join me, Raoul Pal, as I go on a journey of discovery through the macro, crypto, and exponential age landscapes. In The Journeyman, I talk to the smartest people in the world so we can all become smarter together.
Joe McCann, how the devil are you?
I'm great. How are you, Raoul?
I'm good, my friend. Good to see you again.
Yeah, likewise.
Firstly, congrats on a fantastic year last year.
Thank you.
It was a complicated year because it started good, then it was choppy for the whole year, and then ended good. And you managed to navigate that pretty well.
Yeah, thanks. I mean, look, we had a view actually in I think early Feb, and we expressed this view, as you're aware, through XPAM as an LP in our fund, that we thought the end of the year, meaning basically the options expirations on December 27th. Were going to be likely worth a fortune given that they were so cheap in early Feb. So we put these structures on and we kind of wore the P&L throughout the year.
Because it's painful because they just bleed all year.
That's right. And they swing, right? So if you're up in May, the deltas of those contracts are worth a fortune and then they crash in June. But, fortunately, our LPs trust us, right? We had a great year in 2023, our first full year as a fund, and it worked out, right? We did not anticipate a red sweep per se in February, but we had a view that the presidential election, coupled with seasonals and liquidity, et cetera, were likely going to be net positive for Bitcoin, as well as kind of the ETF institutional flows that we were anticipating coming in, which blew, I think, everybody out of the water. And it worked. And so, we're very pleased with the performance last year. I'm sure you and your LPs are as well. In fact, I had one of your LPs in XPAM reach out to me thanking me on Instagram. So,
Oh, really?
it was a good year.
Hi, Raoul here. Listen, I think we've got until 2030 before the economic singularity arrives. Now, it might not be the exact date, but it's around then. So we have about 6 years to figure out how to unfuck our future. I've put together a report to help you called Prepare for 2030. It's going to help you take the first steps in that journey to make sure you're secure past 2030. So just click on the link below and start your journey now.
Yeah, I mean, I think you were certainly the top one or two best performing funds in our fund of funds last year. So the worst thing about running a hedge fund is new year, clean slate, start all over again. The misery. So talk to me about 2025. Let's start with a kind of macro setup first, and then we'll dig into some themes.
Yeah, sure. I mean, if anybody follows, kind of the asymmetric market updates that we publish on Substack, or even just myself on Twitter, at the beginning of this year, I was actually, for the first time in a long time, tactically bearish. And I know you know what that means. It does not mean that all of a sudden I think the top is in and that, things are going lower. It's just that there was this confluence of odd events, which I know you recall on December 18th with the Fed. And what transpired after that was just a collapse in not global liquidity, but liquidity in the markets, right? We saw massive amounts of liquidity just effectively dropping out of the order books, not only in crypto, but also as it related to the stock market. We saw fixed income yields continue to push higher, which means bonds were selling off. We saw the day of the Fed cutting 25 basis points, the dollar rises. I mean, these are fundamentally things you don't assume will happen, and let alone the VIX spiking 74% the day of the Fed, which was the second highest VIX spike ever. I was looking at this going, everybody's really bulled up right now, right? And yet the market is telling us something slightly different. And so we managed throughout the end of the year. Like I said, we had a great year. But for the first couple of weeks of January, frankly, we were short and in cash because we just felt like, look, number one, as you pointed out,
You actually went net short, or you?
Yeah, well, barely, not much, right? And this is all through fixed risk, right? So we put on some put spreads that were basically a 30-to-1 payout, and if they worked, great. It protects the book. We were heavy in cash. I mean, we still had some kind of, you call it January, Feb, March Bitcoin option structures on. So we did have some exposure in case we were wrong and the thing actually ripped. But we just didn't feel strongly that the first couple of weeks, given what had happened the last 2 weeks of 24, were, an obvious long. And we didn't see a bunch of new flows come into the market. And in fact, our view was correct that Bitcoin effectively cracked 90K, went down to 89K, and then just ripped straight up. So we are full bull again. And a lot of that has to do with the macro picture, right? So, you and I, of course, big disciples of global liquidity. There was obviously a break in correlation in Q4 that was largely the idiosyncratic move around President Trump and his win and, frankly, the red sweep. Because we saw Q4 on a notional basis was actually detracting a little bit from global liquidity, but that doesn't imply that the cycle is over. So we still are of the belief that at some point in 2025, we will likely reach some sort of top in global liquidity. That does not imply that Bitcoin is done. It just means that we're getting close. And so my view for the year, based on the information that I have today, is that I really feel Q1 is going to be the strongest quarter for risk assets in general. Q2, Q3, I don't want to say I'm bearish, but it's going to be more difficult. Q4, I think we have the opportunity for a rally again. And a lot of this stems from the fact that the S&P 500 had back-to-back 20% plus years. It's very difficult to replicate that for a third year in a row. It's not impossible. We see a lot of the headlines now, especially with Trump in office, Hundreds of billions of dollars being invested by the Saudis, hundreds of billions of dollars being invested in Stargate, which is the AI infrastructure play. CapEx investments across corporates right now is huge. A lot of this driven by the AI boom. But as it relates to crypto, the sea change shift in sentiment around policy, I think, is actually one of the most bullish tailwinds. I'm sure we'll talk about the strategic Bitcoin reserve, but for me, the bigger thing is SAB 121 getting repealed. That's the staff accounting bulletin that the SEC put out that functionally makes it impossible for banks to hold crypto on their balance sheets because they have to count them as liabilities. That going away, and I know you know this as a former banker or working at the banks, unlocks a huge amount of potential for crypto within not only consumer banking, but frankly on the institutional side and the investment banking side.
Yeah, I mean, I've got a very similar view. Is, I think global liquidity leads and global financial conditions lead that. For me, it looks like we will see the turn. We really need the dollar weaker, which it looks like it's starting to do, and that should pick us up. We know that the Treasury is going to start draining the general account. Reverse repo, last bit of draining of that. They'll probably have to stop QT. Then there's probably a few more rate cuts to come in. I think market has underpriced rate cuts now, having overpriced them earlier.
The fact that our view really is that we think there's still 4 cuts. We think the Fed funds futures market is wildly mispriced at this point, right? And furthermore, I think reverse repo dropped below $100 billion this week for the first time in a long time. The Fed is going to have to end QT, right? Now, one other thing that we're looking into that we think is potentially a huge tailwind is that the Fed could potentially drop the reg caps on treasuries, effectively enabling banks to go to 0% on those and buy an infinite number of treasuries, right? So of course they will. And this is, I think this is, I know you know this, but we want to share with your watchers and listeners that these are tools of the Fed that a lot of people don't tend to focus on. Yes, they know about QT and QE. Great. That's understood. But there are other aspects that they can lever to actually improve the broader liquidity, calm the Treasury market. I think Bessent's going to do a fantastic job as Treasury Secretary. He's a really sharp guy, understands global macro dramatically, especially FX. So to me, the concerns around is the 30-year going to 10%, this nonsense that I keep hearing, it's just not going to happen. They still have a lot of tools at their disposal to make sure that the markets are actually functioning and flowing properly.
Yeah, the other one that's coming in that is below people's radar screen. It's starting in Europe as we speak, which is Basel IV, which is yet another version of banks are going to hold more bonds. But it's all the same thing, right? Which is QE, not QE, which is we'll force the system to own these bonds, and then we don't have to buy them ourselves because QE is now a dirty word. So they'll do anything not to do QE unless they have to.
Yeah, and I mean, look, I think for us, I think we wrote about this back in October of last year. China is still a huge component of this, right? I mean, their economy is not looking great is the diplomatic way of putting it. I mean, they have a major internal demand problem, domestic demand. As you're aware, their 10-year yields are hitting new all-time lows. It seems like every week. It's just the chart is horrendous. Something has to give. And I do think that there is some potential, Jedi mind trick stuff happening between Xi and President Trump that will likely, come to fruition at some point this year. That to me is another massive tailwind that is radically mispriced. And by the way, I mean, you probably know this as well from the macro stuff that you guys do. The PBOC, out of I think the G20 countries last year, was the one country that actually did the least amount of liquidity injections, which implies that if they even mean revert that to normal, there's an enormous amount of liquidity that they could actually bring into the system. So I don't think this is priced either as it relates to liquidity entering the system as well. And how does, of course, this relate to crypto? Well, we see Hong Kong now putting proposals in place to actually put Bitcoin on their balance sheets, right? This stuff is going to really accelerate, I think, later this year.
Yeah, the China thing, the more bearish China is, the more bullish it is for global liquidity. I mean, the simple fact is The Chinese can't stimulate because the dollar's too strong. That is purposeful because the US wants to bring China to the table. China's desperate to print money. We've seen this. This is the Japan, the Europe, the everybody rule book. You get an aging population, you get debt deflation. You have to print as much fucking money as possible. They can't. Because the worst thing for them is to break the currency peg. I know every macro player in the world trades that trade, but it always fails because they're not going to allow it to happen. So the US is going to agree to weaken the dollar in exchange for whatever Trump's going to exchange for. And there's a whole Taiwan trade to be done in this as well. But the point being is, this is almost identical to 2017 when Trump came in, right? Trump came in at the beginning of the year, said the dollar's too strong because the dollar had been ripping on the tariffs idea. Rates have been going up. Trump said the dollar's too strong. China were in the shit. Same situation. And the moment the dollar weakened, China carried all of global liquidity. In 2017, the Fed were raising rates, USM2 was going down, and they were doing QT. So ordinarily, most people who would look at the market and say, well, that's a terrible market, risk assets are going down. But no, China just fucking dwarfed everybody by hitting the print button. And I think it's going to be the same thing.
Yeah, and look, recall, I know you remember this in 2016 as the Shanghai Accord, right?
That's right.
Yellen was actually, she was head of the Fed then, but now, former Treasury Secretary. Remember, she was in Southeast Asia last year.
She went to China twice and nobody noticed.
She's now, of course, out as Treasury Secretary, but you can already, if you can connect the dots a little bit, right? And then also the history rhyming piece. I've seen the fractal chart of Dixie, DXY, and when Trump takes office, for the first 2 weeks, I was like, I don't know, it looks pretty rough. And it was actually decoupling from that fractal, or that repeating pattern, if you will. Now it's starting to look like it's heading directly in the same path as we did with Trump's first presidency. So I completely agree. I think a weaker dollar is actually net positive across the board. That's pretty much consensus. There is this, with Bank of Japan later this week, I think consensus is they're going to hike. We will see how the markets react to that. But ultimately, with Trump is one of the greatest social media experimenters in history. And one of the things that he does is he kind of like A/B tests or beta tests stuff in the market by tweeting, or now on Truth Social and also somewhat on X, right? And the tariff talk, I think, really spooked markets. This guy is a negotiator. He starts way over here and then works his way back. And I think a lot of people forget that about Trump because he's Trump. He's not a standard U.S. politician. He's a businessman. He's a celebrity. And these types of tactics are very effective, which is one of the reasons why, tactically bearish to start the year, structurally bullish for the rest of the year.
Yeah, it's so typical of him. He goes to Canada and says, well, I just want to merge, take you over.
Exactly.
So that's his negotiating start.
Right,
and what he's
exactly.
actually trying to do is get tariffs in play.
That's right.
It's hilarious to watch. So the other thing that I'm thinking about is, okay, and everybody wants to know, none of us know, we don't have a crystal ball, when this cycle peaks. And a lot of people have PTSD from 2021 because the business cycle and liquidity peaked in March. Why? Because 2020 was that massive fall in the business cycle, massive stimulus. It was just a completely squashed cycle. Now, if I look at the business cycle, the ISM survey still below 50. We've barely started going up. So it feels that the probability is this cycle plays into the end of the year or even into Q1 2026. And that's a tail risk. I think the market's going to struggle with this. If I'm right, people are going to get out of risk too early, and they're going to be forced back in at the end, and you get that 2017 final explosion. That's kind of my working hypothesis now.
Yeah, and look, one of the things that we're also tracking that I don't think gets a lot of airtime is the credit cycle. The banks are actually highly incentivized and positioned to start lending pretty dramatically. This should continue to be a tailwind of the business cycle, as you're describing. And I do think, the PTSD, certainly in crypto, is warranted to some extent. But it's just such a structurally different environment, right? You have, the Fed funds rates still close to 5%. Real rates are still incredibly restrictive. They got a lot of room they could potentially cut. If you saw the CPI print recently, this implies PCE has been targeting towards 2% for almost 6 months now. Anything can happen, but the trend is clearly lower. You'll have these kind of idiosyncratic spikes in CPI and PPI, but ultimately the Fed is actually tracking towards their 2% inflation target. And with the boomer of the NFP print that we saw, a couple of weeks ago, granted, we will, of course, see this modified over time. It feels like the Fed still has the ability to cut. And so if you take looking at like the credit cycle, the business cycle, peaking in March just seems low probability. And I do agree with you. I think people are actually underexposed to the right tail at this point of a massive economic boom. I mean, if you see what's even happening geopolitically in the Middle East, you see Saudi Arabia, I think there were something along the lines of a $600 billion investment in the United States. People are coming to the table, with gifts for the president, effectively saying, like, we want to be part of this larger economic boom. I struggle to see a situation where somehow this is done in Q1 of this year.
And also, core inflation is driven by rents. Mm-hmm. Rents are deflating. The forward-looking stuff is now negative, but rents are also a function of mortgage rates. So as rates come down, that core comes down. So I think the Fed have much more cover than people understand. Again, people have PTSD from last time. They stick up the chart of inflation versus the 70s and say, see, this is going to happen all over again. I'm like, no, it's not. It's not even close.
Yeah, and I mean, look, if you look at equities as well, I think the most bearish case that I've seen from any of the investment banks, sell-side research teams at this point is valuations. And I don't even think they're that stretched at this point. But more importantly, I mean, yes, Mag 7 has continued to really outperform. We're starting to see signs of breadth improving. If you just look at like the Russell as an example, since Trump came to office, it's done extremely well. These are all net positive longer term for the broader economy, especially as you look at small caps, because these are the folks that are super interest rate sensitive, right? Because if you're, Apple or Google and you've got tens of billions of dollars in your corporate treasury, park them in T-bills. You love high interest rates. But if you're, a small automotive manufacturer in, rural Ohio, you're borrowing to fund your business. And so I think part of the challenge with looking at the future for rate cuts, with people saying like they're done for the year or there's only 25 bips price or something, it just doesn't make sense, especially as you look at what's happening in the broader economy.
Yeah, we got two economies and people can't see it. One is driven by liquidity, which is the tech stocks, and all the others live off debt and earnings. And if you ask the average business across anywhere in the United States, they're not seeing a boom time yet because the ISM survey is below 50. So we're not. So we've got two different forms of economic growth, and half of the growth that we got right now is the kind of pre-election goosing of tax and other stuff that's happening. So it'll work its way out. The economy will slow down. The Fed will get more aggressive, is my general view. So given this, we broadly agree, and again, we don't have a crystal ball, but we broadly agree. So let's talk about asset allocation at top level. From my perspective, as the ISM survey picks up, in fact, when it crosses 50, it's pretty much the perfect signal for alt season. So you might have been playing Bitcoin call options last year, but how are you thinking of this year I mean, you were a big Solana holder and other stuff as well, but what do you think your asset allocation strategy is going to look like? Right now? I mean, obviously it can change, but...
I'm going to respectfully disagree short term with you on alt season.
Yeah, and that could be true, yeah.
And part of the reason is that, like, I've had a view for quite some time that I don't think Bitcoin dominance has actually topped. I think it actually still has some room to run. This doesn't mean that certain alts won't actually rise. It just means that it's not a true alt season until you see a complete, kind of reversal in Bitcoin dominance. That being said, the alts that we are actually looking at, I mean, the size of our fund, we can't be in the trenches with the degens, so to speak, right? But I do believe that if you look at obviously things like Solana, right? Like let's just call it what it is. Trump launched his meme coin 3 days before his election, or inauguration, I should say.
We'll come back to that later.
Yeah, we will definitely come back. But if you look just fundamentally what happened on Solana, hundreds of thousands of new people onboarded, records amounts of trading volume on DEXs, record amounts of tips on Jito, which is a service that you can utilize to land your transaction faster. I mean, it's very difficult for me to still see a scenario where either A, Solana should remain 1/3 the value of Ethereum, or B, any of the high performance, high throughput chains can currently catch Solana. Now, I'm a trader, right? I understand the technical underpinnings of things like SWI, which is fantastic. I know Evan and the CTO there that invented the Move programming language. As you recall, I'm a technologist myself. This is a very powerful potential L1, but as a trader, I want to trade it. So yes, absolutely owning something like SWI in addition to Solana, I think provides you some beta to your Solana core positions. And as the Solana ETF comes to markets, we saw yesterday a leaked version on the CME of Solana and XRP futures are going to start trading. The vol will start to slow down a bit in Solana, but the demand for it is nowhere near done. I think this thing has a lot more room to run. Now, secondarily, on the asset allocation piece, it is no surprise that we were the first fund to actually start trading and investing in meme coins in 2023. And this is one of the things that was a huge performance driver for us. If you actually look at the top 10 tokens for 2024, what was the number one performing asset? Dogecoin. It outperformed Bitcoin, Ethereum, Solana, everybody.
I was long Doge. It's the Elon plus election plus memes.
It's a no-brainer, right? And then when he named the agency Doge, I was just like, you've got to be kidding me. This is so obvious, right? And in fact, Doge.gov website has a picture of the dog on it.
He's telling you this, right? It's a simulation and he's telling you what he's going to do, which is he's going to use it on X and use it on Starlink and everything else.
Exactly. And so from my perspective, I think, we own some core positions in what I would consider a blue chip meme coin. So these are things like your Doges and Bonks and kind of Pepes of the world, right? And part of that is a function of the liquidity available in the markets. We can't be, buying $100,000 of something is just not moving the needle for us, right? So I do think that, trading these things tactically, but having a core view that meme coins needs to be a part of your asset allocation is going to be key for the rest of the year.
I can't imagine a world in which a Doge ETF is not phenomenally successful. I've been begging Jan van Eck for a year now to say, file for this bloody thing before somebody else does, because it's going to get $30 billion of capital.
100% agree with you. And by the way, Bitwise, which I'm an investor in, they just filed for their Doge ETF, right? So this is coming, right? And last year when I was chatting with Jeff over at Bloomberg, who's one of the guys that works for Balkunis on the ETF stuff, when the Ethereum ETF, spot ETF got approved, which caught everybody by surprise, my immediate view was Solana's next, and there's going to be an utter proliferation of these ETFs going forward. And the reason is, as you know, asset issuers love to make money on the fees of these things. And if they look on chain and they see trading volumes of meme coins or pick another token, they're going to want to wrap that up and make it available to folks that typically just use Robinhood or E-Trade or Schwab or their own broker, right? This is not slowing down. I think you're going to see a massive proliferation of these ETFs. And of course, when an ETF is announced for a particular token, the value of that token tends to rise. So a lot of these are going to be meme coins. TradFi is going to have to start accepting the fact that things that have no fundamental value are going to be traded on the New York Stock Exchange and the NASDAQ.
They are going to have to understand that they never understood the internet. It was always a game of attention.
Exactly.
And they don't realize that attention is upstream of everything. Personal relationships, work, everything is attention. And this is a capturing of attention.
And look, I've mentioned this many times, and I mean this with no disrespect to people that went to business school. But if you go to a Chicago business school, there is no curriculum teaching you how to value culture. it doesn't exist, or value attention. Now, you can look at things like monthly active users and daily active users and use some sort of modeling for that to figure out what the value of, meta would be. But when we're talking about the tokenization of internet culture or culture in general, there's just no discipline around this. And I don't blame these guys, right? It doesn't actually fit their mental model, let alone their training that they got to be able to value things. They look at things like discounted cash flow, price to book, these types of things. That doesn't exist for culture, because culture it's not tangible. It's just it's more art than science.
And it's an intangible on the balance sheet. I've said this many times on many conversations, is Disney has more culture that is an intangible that does not get reflected in equity.
That's right.
But if you tokenize it, it goes to a tangible on the balance sheet, right? This is a very big concept that people don't yet understand.
I completely agree.
The other thing is, as yet, Wall Street hasn't figured out that all of this, from Meta to Doge, is all Metcalfe's law. And
exactly.
So it's how to value networks. And Doge is a unbalanced network. So it's lots of retail investors, very little on-chain use. If Elon brings use, you're going to see a multiplier effect on the value of this thing. It's as simple as that. Well, Ethereum has got both sides. Lots of users, lots of value gets transacted. Bitcoin, Solana, all of those. So once you understand what makes a network valuable, these things are much easier.
Oh, I completely agree. I mean, there's two things here. One is, so I was a CTO at one of the top ad agencies in New York City, 12, 13 years ago. And working in a place like that, the CEO at the time was a close friend of mine named Andrew. He kind of taught me the value of brand equity, which is what you're describing with Disney, right? But it's very difficult to, frankly, tokenize or securitize brand equity, right? Brand equity is the je ne sais quoi of Apple or of Tesla or of Disney, right? Or of Nike. This is the brand itself has this cachet associated with it that if you look at a company like Nike and you look at a company like Adidas, Nike's brand equity is arguably worth more. Now, how do you price that? It's difficult to price that in the traditional sense, right? I think the second piece to your point about Metcalfe's law, I was having this conversation with some founders yesterday. They were looking to build a super secure peer-to-peer encrypted messaging app. And I said, how are you going to disrupt WhatsApp? And they're like, well, it's just more secure. And I'm like, no one cares. No one cares about that. What they care about is, are my friends on this? The power of a network is extremely valuable. And so to your point, if, Elon Musk decides to flip the switch on Dogecoin for payments on X or whatever, then all of a sudden, how many hundreds of millions of people on a network just get lit up with something like Dogecoin? The value of that creates a digital repricing event that I don't think people are actually pricing in.
The other one, talking about brand equity, this is what people don't understand about LVMH and Hermes, right? Their charts look like Google or Amazon, or they're log regression channels. And everyone's like, what the fuck is this all about? It is because they actually price brand equity in their goods.
That's right.
So their margin is ridiculous. The network effect of people wearing a Louis Vuitton handbag creates the value in the number of goods sold and the scarcity value, and then it drives this equity. It's Metcalfe's law. It's bizarre, but it's Metcalfe's law in handbags and fashion.
I completely agree. And look, speaking of folks like LVMH and the large fashion houses, there's a company, I'm good friends with the CEO of this company called Mischief, MSCHF. I can assure you, most of your listeners probably don't know this, but their kids know who Mischief is. They are arguably on the kind of the tip of the spear of internet culture, and the fashion houses are now working with them. They want to be involved with companies like Mischief. Why? Because they understand the brand equity associated with something like LVMH, but they also understand that the tides are shifting to the internet. A lot of the traditional customers of LVMH are now being, frankly, aging out, for better or worse, right? A diplomatic way of putting it. They understand that, hey, we need to be able to start to shift our focus to a new kind of cohort of potential customers for us. And the way that we do that is embracing the internet and ultimately internet culture, which is one of the reasons why they work so closely with companies like Mischief. It should be no surprise that Mischief is also now interested in Web3. So you can start to see this kind of confluence of brand equity, meme coins, internet culture, and Web3 starting to really come together because they have to.
I mean, this has always been my working hypothesis, and I set up a business 4 years ago to deal with this kind of tokenization of culture, and it was too early, so we eventually gave the money back to investors, but this is coming. We're starting to see, for the first time, Web3 native brands, doodles, penguins, stuff like that, which is interesting. I don't yet know whether these will blow up, and the Rec guys are trying to build as well, all of that stuff. Ovi and Mando, G-Money's got this fashion thing. There's stuff coming there. I don't know. What do you think about whether we can break out the other way, or do we have to go and tokenize existing culture, or can we create culture and let it go viral into the normie world?
Yeah, I mean, I think the short answer is it's both. And frankly, I've been evaluating this for quite some time. We are actually going to be launching Venture Fund 2 at Assymetric, which is the first crypto/Web3 VC fund exclusively focused on consumer-based applications. My view is that we're actually at the point now where we don't need to keep investing in infrastructure. Do we have infrastructure investments in our previous funds? Yes, but look at what happened with the Trump meme coin. The technology is there, and I'm not just backing Solana on this. The types of applications that we can now build with this core technology is available, right? So if you just go back to call it 2005, 2006. How many VCs were investing in laying physical infrastructure for the internet? The number is zero. What were they looking at? They were looking at companies like Groupon and Twitter and Instagram, these types of applications that are built on top of the core infrastructure. I think we're at that inflection point now, and the key will be, how do we make Web3 be magic in the background? It's not about connect your wallet and do these things. No, it's how do entrepreneurs and innovators utilize this new form of technology in ways that consumers can embrace it. Now, the typical thing, right? So you saw with the Trump launch, Moonshot, they just crushed it. But that's a very specific type of application where you're just basically swapping or wanting to buy tokens, right? That's great. That's a good use case, and it worked. However, if you start to look at companies like Moonwalk, this is an actual consumer-based application. This company, they basically have folks go on these they create these competitions to go on walks, right? Get your steps in. And they post, Solana as collateral, and whoever is first place wins the prize, so to speak. The app is exploding.
So this is like a new version of STEPN, essentially.
Yes, but I would argue much better.
Yeah, obviously.
because with STEPN, there was a token associated with STEPN. Currently, there is no token associated with Moonwalk. But the point is, they're using the technology and applying it to something like fitness, right, in a meaningful way. In addition to that, there's a company that I'm invested in called Golfin, Golfn, and they're doing something very similar. They're building, effectively like a digital caddy for folks that play golf, and they're meeting brands with their end users, and there's NFTs and also a token associated with this sort of a product. It's all abstracted away, though. Right? So my view is we're going to start to see a lot more of these consumer-based applications. And do I know what the breakout application is? No, of course not. It's just like the AI industry that was around for 70 years and nobody was asking to be able to speak to a chat bot, right? That happened to be the breakout application. But these things are coming, which is why I want to invest in this ahead of the curve over the course of the next 2 to 3 years.
So here's a broader question around this. Does everything need a token? I think we're trapped in thinking things need tokens. And I see what Coinbase has done with Base, and I think it'll end up accruing to the equity. And we don't need to have this hybrid structure unless it's truly needed, or we can have tokens that are non-traded, our loyalty tokens and stuff like that, that are just part of the the engine. How are you thinking about that at VC level? Because the market, I mean, there is going to be tokens, obviously, but it feels that we're over-tokenizing all sorts of shit. And every time we go through a down cycle, these things never recover. And I think you're destroying businesses, future businesses, because of it.
Yeah, I mean, look, like all credit to the base team. Rolling out that L2 with effectively no token, right? Currently, there's no token, and there's obviously speculation that there may be at some point. But it's a revenue-generating business for Coinbase, which makes total sense. It's a very good use case of how to utilize Web3-based technology to benefit shareholders of a publicly traded company. I think you will see a lot more of this. The difference is that it's technically still infrastructure, right? And it's a great use case, and it's great for Coinbase. What I would like to see is beyond infrastructure, what are going to be the things that businesses are going to utilize? The first one is super obvious. My friend Kyle Samani over at Multicoin wrote a great piece that went out recently about, Solana and it basically being like the rails for high frequency, or excuse me, for finance in general, right? I'm butchering it. Sorry, Kyle, but that's effectively what this essay is about, and it's extremely well written. I think one, if you look at payments, super obvious use case. Everybody's looking at that. But two, and I think this is one of the key things that happened last year that didn't catch a lot of people's radar, is that when Stripe went and acquired Bridge for $1.1 billion, a few things happened. One, Stripe is the, darling of Silicon Valley, right? That board is not making the decision to go and acquire a company like that if they don't see where the future is heading. So two, it also gave Silicon Valley VCs the agency to be like, hey, there's exits in Web3 based companies. I can now go and safely, big air quotes there, invest in these businesses because there's going to be these types of acquisitions. And we just saw Circle recently announce their acquisition of a company that does tokenized treasuries.
And Circle itself will IPO.
Exactly, right? I'm full disclosure investor in Circle as well. But yes, like there will be, and I mean, the head of the NYSE came out a couple of days ago saying, we expect more crypto IPOs coming, right? So I don't think this kind of stuff is going to slow down per se. The question really is, how do businesses get smart quickly, whether it's on the corp dev side or it's their product strategy side, to not say, hey, let's do what IBM did in the last cycle in 2019 and create a permissioned blockchain which defeats the purpose and creates a shitty database. Let's actually find ways of utilizing the technology for problems that our customers have or for net new products that we want to expose to our current customer base. That's actually, I think, much more valuable than just saying like, hey, we're a cryptocurrency exchange. Let's just go build another L2 because it was successful for Coinbase.
The two big ones, I always look for really big use cases. The two really fucking massive ones that people don't understand, and you will, ads.
That's right.
Right. The high frequency trading of ads, it's a filthy business. And it's the same with tickets, right? They're both the same. It's in fact the same high frequency traders that are involved in them. And it's a filthy business because client A, the buyer and the seller of the ad, is paying, the price gap is so massive, and it's some of these ads get traded 1,000 times before it actually gets to the end buyer of the ad space. This whole thing needs to go on blockchain, and it's gigantic. It's like a dark economy that is much bigger than people understand.
I would love to invest in any company that is building that. Because I think there's two things here, or there's two instances that come out to me that are challenging for this to be usurped. The first is the ad tech space. They have a pretty strong network effect, right? It's very difficult to wedge into that. And then second, I mean, Ticketmaster and Live Nation effectively have a monopoly on ticketing, certainly in the United States. And yes, there's been, I would say, some discussion in Washington, D.C. as to whether or not this is fair or not. But someone is going to have to figure out a way, just like we did in the 1990s when the music industry basically had an oligopoly on music distribution and production, the CDs, the pricing, all these things. the people had enough and created Napster, right? They weren't saying, hey, we're going to try to destroy this industry. We just want an alternative system. I think that that is likely going to be the case with, say, something like ticketing. Could be an easier, big air quotes again, easier approach for a founder and entrepreneur to wedge into. The challenge is that industry, the entertainment industry, they actually don't make a lot of money, those artists. There's a handful that do like...
No, 80% of the economics go... I've been down this rabbit hole with a lot of artists trying to sort this out. Problem is there's like 10 different people own different slices of the IP rights. It's an ugly, messy business.
Yeah, and I could see, dare I say it, someone like Kanye West look at what happened with Donald Trump and say, I can do that, and then I can also use that to create a more democratized version of a record label or something to that effect. It's very difficult to forecast something like this. However, the technology is now available and ready to enable these types of entrepreneurs to take a swing at it. And I think that this is one of the reasons why I want to find these folks and invest in them, because there are going to be outsized winners, just like we saw in the late 2000s for, the applications that were built on Web 2 will now apply to applications built on Web 3.
Yeah, and to your point, it is really not easy to know what it's going to be. The things that I thought were going to happen fast still haven't happened, and the things I never expected happened. Donald Trump launching a meme coin was not on my radar screen.
Same.
But NFTs for tickets has been on my radar screen for like 5 years, and it's still not got there. So
that's right.
You don't know what the breakout's going to be, and it could be something entirely different. Who knows? Even Doodles could become a giant brand, which is going to then lead other brands to kind of reverse into normie world in ways we don't yet understand.
Yeah, I mean, this is the hardest part of being, a early stage investor is you're trying to predict the future by connecting the dots of what. And so one of the things that I try to do is I'm somewhat of a student of history as it relates to technology, particularly internet technology. So, small section of history there from like the 90s to now. And I just try to look at are there patterns that could potentially repeat, right? And I use the Web 2 to Web 3 example, and I look at it and go, yeah, they stopped investing in infrastructure in the late 90s, early 2000s. And then a few years later, we had this explosion of Web 2-based applications. And the
VCs made more money out of that phase than all of the other phases added together.
I completely agree. And this is exactly what my point is that do I know what the breakout application is going to be? No. And I don't think anybody knew that Instagram was going to be such a massive, breakout application as an example, right? I mean, I remember when Zuck was coming out saying he wanted to acquire them for $1 billion and the sell-side analysts were saying he was absolutely insane. Look at that business now, right?
WhatsApp for $19 billion.
Yes, exactly.
24 people, $19 billion.
Yes. And this is what my point is, right, is that those types of applications are going to exist. I think one of the key differences now is the way that capital can be formed in Web3 is so fundamentally different than it has been, frankly, ever. And the fact that the president of the United States, not only, whether it was I doubt it was him directly, of course, but his family, his name, not only issued a token as an American citizen and, frankly, the president of the United States, but he's also an investor. This fundamentally changes everything we've known legally about structuring tokens and capital formation in the United States since the dawn of Bitcoin. And I think that is why this is such a seminal event, probably as big as the genesis block of Bitcoin, because now you're basically saying, hey, not only did the president launch his own token and a bunch of money flowed into it, we can debate the moral arguments around that. I don't really care. What I'm actually focused on is the United States could actually become the launch pad going forward for this new form of capital formation as well as token issuance. And that is such a huge tailwind to the crypto industry.
Yeah, I think people don't yet understand. We have been testing this capital formation idea since ICOs. Right? We tested it. That one didn't work properly. Memes are another way of testing it. That's often without a VC involvement of an earlier stage. So i.e. no product market fit or even, a deck or whatever. What we're doing here, as you're saying, is we're about to restructure how capital is formed. And what, again, people don't understand, it took half a day to coalesce $75 billion of value, right? That has never happened in world history.
Correct.
Right. I remember back in 2020 when Mukesh Ambani in one day bought back $18 billion of debt or $13 billion of debt, right? And did it all in equity. It was like, okay, that was capital formation at scale, the largest we'd ever seen. This fucking dwarfs it.
Exactly. And it was instantaneous and it was global.
And the other one we saw this with, which I said at the time was a signal, was the Constitution DAO.
Yep.
Same idea is look how fast you can form capital around an idea on the internet.
That's right.
So I don't know what it's going to mean, and I don't know where the regulatory aspect lies within this, but this breaks down and turns everything into crowdfunding. It levels the playing field on many things.
This has honestly been my view around, you know, once the ICOs happened, the light bulb went off for me. I was like, this is the kind of first time we've had a globally democratized way of raising money. Now, are there going to be scams? Yes, there's scams in TradFi too, right? Like, I mean, it's the same. It's not like, you know, I love the fact that people focus immediately on, well, there's going to be so many scams. It's like, right, but what about the positive stuff that's going to come from this, right? You now have the ability for, frankly, anybody with an internet connection and a crypto wallet to participate in something that they, frankly, never had access to, right? I mean, we know this running funds, you have to have accredited investors or qualified purchasers to even get into the thing, right? This changes all of that. And I don't think people really grasp how big of a shift that is, because look at the speed that you can raise money from myriad people around the globe. And yes, I'm sure there's going to be people debating, well, where's this money coming from? We're already seeing, you know, folks on the Democratic side of the United States, Maxine Water and, you know, the folks like Elizabeth Warren saying like, well, who's investing in this meme coin of Trump and what are the disclosures and this and that and the other? That's going to happen. But the problem with, I think, looking at DC and the way that they currently function is they're operating in an analog world. The digital world is so much faster that you actually need people around you that understand it. Maybe the people that built it, like David Sachs and Mark Andreessen and Elon Musk, right? So this is another reason why I feel so bullish about what's happening in the United States right now and as it affects not only innovation in the United States, but I would say globally, is that you actually have, you know, folks that are representative of a modern day Manhattan Project in the United States government trying to affect change in a positive way that's going to create, I think, one of the biggest economic booms we've seen in a long time.
Yeah. And I think you'll share the same. I have a very fucking strong opinion is that the regulatory rules about who's allowed to invest in what is just basically all about middlemen.
Oh, yeah.
And so, you know, the whole regulatory framework about what is a security, what's not a security, you know, who's an accredited investor. Oh, because you've got $1 million, you're now suddenly smarter than the guy who had $900,000. It's fucking stupid. And then you give the audacity to say, well, you can't invest in this stuff because it's risky, but you can go to Vegas and just blow your entire fucking check, right? And then you have young people who can't afford to buy a house, can't get ahead, their wages don't go up as much as assets from debasement, and you tell them, oh, we're going to fight an election on not giving you your opportunity.
Exactly.
And then we're going to ban you from trying to invest in the opportunity so the middlemen... this is not going to wash. There is no way this will last.
I agree. And look, I was being interviewed by a Financial Times journalist the other day, and he asked me point blank, you know, are investors at risk of investing in meme coins? And I'm like, are investors at risk at investing in anything? I mean, think about it. Like, if you invest in something, you are putting risk to work, knowing that there's a potential loss of principal. Period. End of story. And if you need the nanny state government through agencies like the SEC to protect you, well, go talk to the Madoff victims. Because the year before Madoff actually imploded, the SEC gave them a clean bill of health. So I don't think this argument that, hey, these folks, we need to have it approved by this archaic set of rules from the 1930s to protect me is actually relevant anymore. And people want access to this type of stuff. Again, the alternative financial system that crypto and Web3 has created is not meant to simply replace the current one. It's basically saying there's an alternative thing that you can access. That is the big unlock.
And, once you apply AI to look for what is scam, what is not, these things can be spotted. You'll be able to filter out a lot of this pretty quickly and action it quickly too. It doesn't have to go to bloody court. It doesn't have to take all of this time. There are ways of dealing with this using technology that's much better than using laws from 1933.
Yeah, I mean, if you're running a company, are you running it based on, the principles of almost 100 years ago? I mean, you're not in business if that's the case, right? The companies that have been around for generations consistently adapt to the new environments. It's time that we, certainly I'm speaking from a US perspective, do the same thing at a policy and government level. And this is, I think, one of the reasons, you've seen Mark Andreessen, who's an LP in the fund. I love seeing this guy. He's been on every podcast. Like, I think he's doing like a new podcast every day. I haven't seen him this excited, I think, ever. And it's because there's the chance now we can kind of break up this ridiculous set of layers of bureaucracy and bullshit around regulations and policy that are restricting innovation and growth in the United States and, frankly, globally.
And I agree, and I'm very excited by that. The flip side is that may be true, and it may be a kleptocracy and a whole big grift.
Oh, 100%. And I'm not discounting that to zero, and I sympathize with that argument. My counter argument is, was what we had a better alternative? I mean, you have people saying like Donald Trump's grift in this meme coin is so obvious, et cetera, et cetera. It's like, right, but did you know that Nancy Pelosi outperformed every portfolio manager last year? And it's just sure is ironic that she can buy call options on companies right before news seems to hit that's relevant to those industries, right? Like, this happens within DC. They just have a way of covering it up or keeping it obfuscated. Trump is literally doing this in the open on a transparent, permissionless blockchain that anyone can access. I think that is missed in the media cycle right now because they want to focus on how Donald Trump is a grifter. Why not focus on how DC actually works? He's just doing it in plain sight.
Yeah, I think that's exactly the case. So what else interests you for the balance of 2025 outside of the big things we've talked about? Is there any other specific... Oh, actually, one question I did want to ask you, because I don't know how to do this. It takes a certain mindset to run a liquid crypto portfolio.
It does.
A certain, you build portfolios in a certain way, etc. And VC is very different, right? Because you don't know what the winners are, while in the liquid book, your entire fucking job is to concentrate risk in the things that make the difference. How do you run that dichotomy in your head? Because you're either kind of built one way or the other. I've seen a lot of VC people trying to do liquid. They can do well, but generally it's harder. Or the liquid people trying to do VC.
And it typically doesn't work, right? Yeah.
No, because we're so used to take a theme, bet on that theme, and it might be the wrong, you know what I mean? It's just complicated. Yeah. Or too complicated portfolio.
It's a great question, and I will try to say this with humility.
Yeah, because we all wear egg on our face pretty quickly in this industry.
So look, I've been a technologist and a trader for 25 years now. I started a company, bootstrapped it years ago, an open source enterprise infrastructure company, raised over 40 million in venture, and sold that business in 2019. I started doing angel investing and advising to startups. But I've been trading this entire time too, just mainly on my own personal balance sheet. And when I kind of was proposed the opportunity to join a fund and then ultimately ran my own, my mindset was, hey, crypto venture, yes, there's some fundamental views that you need to have, like, for example, the consumer-based fund that we're going to be launching. You have to have a kind of hypothesis here and thematically invest in that, right? However, the big difference is that we know, and you know, that the liquidity events are way faster in crypto. And that requires, frankly, a hedge fund, trader or portfolio manager's mindset. For example, when I'm looking at some investments, and I won't name the investment in our previous VC fund, but this came across to me as a deck that was like at a $40 million valuation, and I was like, way too rich for a pitch deck, right? I said, if you come back to me and kind of build this, I'm happy to pay a higher valuation because I knew they were issuing a token soon, right? So you look at it and go, is this a long-term 10, 15-year investment, or is this a trade? And I think that this is one of the things that's lost on a lot of VCs because, frankly, they're not traders, right? It doesn't mean that I'm dumping my tokens that I invested in this private round. It means that I can actually manage the risk of that in the VC portfolio kind of like a hedge fund manager, right? And that is one of the things that I think has been kind of our superpower. We've done extremely well out of Venture Fund 1. Our Asymmetric Bitcoin DeFi Venture Fund 1 is doing well as well. And it's because we have this mindset. We do have these fundamental views, but we have this skill set of understanding how to manage the liquid side because it comes way faster than I think traditional VCs expect.
I also have a strong opinion, obviously running a fund of hedge funds, that the hedge fund industry is undercapitalized versus the VC industry. So valuations, tokens come out, most of them fall 70, 80, 90%. Right? This is they're dumping on the public. It's not. It's because there's no fucking secondary market yet. So to be a hedge fund and to find the right ones, and I spoke to Richard Galvin about this, is you get some great opportunities, right? You choose the ones like, Sui would be a great case. Comes, dumps, you buy it, whether some of these others, whether Celestia or whatever is one of those, I don't know, but that's what a hedge fund's job is to find the rubies in the dust. There's a great relationship there between the illiquid markets and the liquid markets.
Yeah, and I mean, this is, I think, one of the things that we look at on the hedge fund side is, there's a lot of short opportunities in crypto, as to your point, right? I mean, I wrote about this in our last market update that if you look at the layer twos, so your kind of Optimisms, Arbitrum, Polygon, and even Blast, which was launched last year, they were all down over 50% for 2024, right? And why is that the case? Well, there's probably some structural Ethereum issues, and Ethereum underperformed, and maybe there's not a lot of interest in L2 tokens. Who knows, right? Vesting schedules. Put your narrative out there. Those are great trading opportunities, right? But shorting in crypto is the fastest way to end your career. So you have to do it in a very kind of tasteful, tactical way. And this is why, I get back to the SAB 121 repeal, if the banks can actually start, frankly, offering prime brokerage
brokerage, yeah.
They're not going to focus on the longer tail of tokens. However, the broker-dealers that we trade with today, like your Galaxies, Falcon X, DRWs of the world, they're going to have to start offering derivatives on the longer tail of tokens. And so will this, stop the bleeding, so to speak, by some of these projects that can't seem to catch a bid? Maybe. But I think more importantly, you have safer ways of being able to trade these things. And so we're really excited about that potential opportunity because the crypto native broker dealers that offer derivatives currently in crypto, I mean, no disrespect, but good luck competing with Goldman on this, right? It's just not going to work. You're going to, I think they'll see, good for us, spreads will collapse, but also they're going to end up taking a lot of that flow if they can start to onboard folks like Asymmetric as clients. They're going to have to compete elsewhere, and that's likely going to be the longer tail of tokens.
The other narrative that I'm still chewing over, because I don't think it's right, is this VCs are dumping on us.
I love this one.
Because what everybody's asking for is a fair launch. So a fair launch is now a meme coin that has nobody in it. They kind of get in. And what do those fuckers do? Dump.
They complain.
No, and then they dump.
And then they dump.
It's like, okay, so either retail dumps on you or early stage investors need to get compensated for the risks that they took, and they will take profits, and they should take profits. There's obviously egregious ones where if you saw a founder selling all of his equity in the first week, you would say that is not a good thing. So yes, there's a very big difference between founders, devs, all of that stuff, and early stage people who put in risk capital to bootstrap a project, whether it's in a meme or whether it's in another project that has VC involvement, they're the same thing.
Yeah, I mean, one of the things that you're identifying here is the culture of kind of crypto Twitter, or just like the kind of like crypto native degen community, if you will. There's these if folks are new to crypto, it can be, you know, very toxic. It's probably the easiest way of putting it, because there's some basic default stuff that they're going to say no matter what. One, everything is a scam. That's just what people say. Two, VCs are dumping on you. Three, Joe McCann and Raoul Pal are KOLs, so they're dumping on you, right? This is consistent with the engagement models of the platforms that this information is actually propagating on. Controversy, anger, frustration feeds the loop, so to speak. None of it is typically true. I don't want to say all of it isn't true, but none of it is typically true, right? And that's not going to change. The VCs dumping on folks, like I was in this Telegram chat the other day, and this guy was claiming that I was doing the same thing, and I was like, dude, why would I sell Jito here? Like, they're printing new all-time highs in revenue. You think I'm dumping my tokens here? This is crazy, right? This is never going to end. People are going to constantly be upset about something, right? The fact that there were multiple millionaires minted off of the Trump coin, more people were upset about it than the people that were stoked that they made money on it. This is not going to stop, and it frankly is only going to accelerate as we start to onboard even more people into crypto. And I do feel that, you know, I feel a little bit of empathy for the folks that are going to be entering this wild space, because it can be pretty combative and toxic. You just have to zone all of it out.
Well, because it's like a feeding frenzy of sharks, right? There's money to be made and people are desperate, right? There's a desperacy. That's why this happens. It's like, I need my share. He's getting his share. I want my share. I've got to have it. I've got to have it. And it's that feeding frenzy that creates the ugliness. And I get why as well.
Yeah, I mean, look, there's nothing worse than watching your neighbor get rich, I think is the old adage, right? And you can do that on the internet 24/7, right? So, yeah, I mean, on the one hand, should we figure out better ways of avoiding rug pulls? Yes, of course. I mean, no one is debating that. But complaining about it is not changing the system, right? Like, I have a rule with folks that work with me at Assymetric, and I say, don't ever come to me with a problem without a proposed solution. Like, because then you're just complaining to me, right? Like, yes, I know as the CEO, like, everything's my fault. I can't take credit for anything, and I'm a complaint department. But if you see something that's wrong, propose a solution. People are not going to do that on the internet. And this is why I don't think this is specific to crypto, but it's amplified in crypto because there's money behind it.
So to ask the question I was going to ask a while ago, what are the other themes that are interesting for you that could grow into bigger themes this year? And again, we don't know, things change, but what's on your radar screen?
So I have two. One of them is going to be pretty obvious and has been highly touted, which is, of course, agentic AI and crypto and the kind of, you know, merging of those two things. I think we're going to start to see kind of a 2.0 version of this. We saw in Q4 the kind of rampant acceleration of these agentic AIs that basically tweeted, and people thought they were going to be worth trillions of dollars.
And the other ones are, there's a lot of macros that, like, you know, they're not agents yet, but I can see where it's going.
Exactly. I mean, and this is I think, like, my background in computer science and software development is like, this is the first iteration of this, right? Yeah, some people are going to make some money, but the idea that the first iteration of this is going to be the thing, I mean, look at the internet. Web 1.0 was definitely not Web 2.0, right? It's the same concept. So I think of this as almost like versions of software. Agentic AI is going to have another 2.0 kind of cycle where we'll start to see what are these innovators and builders building that's driving more attention and or more utility and value. I think the second one, and I wrote about this in December, which I still hold to be true, I don't think a lot of people are focusing on the fact that governance tokens are likely wildly undervalued because of the protocol revenue that these protocols are actually generating, right? So, for example, if you look at like Athena or even Jito, for that matter, they have proposals out there. I mean, Uniswap has had a proposal to turn on the fee switch forever, right? Why haven't they done that? Because the regulatory environment in the United States has been so combative that the founders are not willing to take the risk to quote unquote issue dividends to their token holders, right? So if you look at TradFi, like the stock market, there's roughly three major components of a stock. There's the issuance, the IPOs, secondaries, whatever. There's buybacks, which takes stock off, supply off the market or out of the float and kind of either puts it back in the likely back in the corporate treasury. And then the third piece is dividends. Those are the three kind of major components. Yes, there's probably some other nuance here and there, but roughly those are the three major components of a stock. In crypto, we have ICOs, token generation events, so the issuance. Buyback and burns happen, absolutely. That's effectively the same thing as stock buybacks, but in fact, the supply gets destroyed, so price go up. But three, issuing dividends has not been a major part of crypto for a long time, and that is because founders are frankly and justifiably afraid the SEC will say, oh, that's a security, you're issuing dividends. I think all of this changes now, especially under the new administration, is that you're going to start to see tokens with those three components represent the three components of stocks. And a lot of these protocols are really undervalued based on the revenues that they're generating.
So using a like-for-like comp with an equity, because that's what will happen. Once you use the DCF model, you're going to end up valuing the same as growth equities.
And so for the longest time, I've been pounding the table saying applying a DCF model is just stupid to something like crypto because it's the value of the network. This was before we had a huge change in the regulatory environment. Now I think there's a case to be made that a lot of the folks that have learned that type of analysis in business school and applied them to equities can start to modify that a bit and apply it to things like governance tokens that generate real revenue. I mean, if you look at Maker, you look at Athena, you look at Jito, the annualized run rates on these things, which is a poor metric, but just to kind of extrapolate out, they're in the billions of dollars, right? These are not tiny little startups generating $10,000, $20,000 a month. Well, how does that apply then to the token price? There's other aspects of a token that are fundamentally different than a stock, that this is where like the TradFi and crypto native mindset needs to merge to find the appropriate valuation for these tokens.
Yeah, because you end up with, the way I think about Metcalfe's law, part of it is the value transacted, the total value transacted. And what you're going to do by adding dividends is increase the value transacted on the network. These are not straightforward DCF models like you'd use for gold mining stock or whatever it is. It's actually Metcalfe's law, but with extra value added. So I think you're dead right. I think I've been looking at these for a while and just thinking, they're going to be interesting as well.
Yeah, I mean, we haven't necessarily pulled the trigger yet. We kind of want to see a little bit more, want to get a little bit more comfortable with what the regulatory environment is going to look like. But, proposals are passing for this type of stuff. And in fact, I'm advising portfolio companies that either I'm an investor in or an advisor in to say, hey, look, if you're generating all this protocol revenue and it's just going into the DAO's treasury, which is great, but I'm pretty sure that you could start issuing this to token holders and it not be some, I tell them I'm not a lawyer, of course, but like, I don't think it's going to be as egregious or as risky as it has been given the new administration.
Super interesting. Joe, look, phenomenal conversation. We'll probably be speaking for hours because there's a lot. But, look, I loved it. Really enjoyed it. Good luck for the year. I'm sure I'll get you back some point during the year to chat. And I'll see you in Miami next week.
That's right. Looking forward to it.
Yeah, absolutely.
Thanks,
There's a lot of people going. There's like 500 people from around the world coming in.
Oh, really?
There's like 30 events.
Oh, my God. Oh, yeah. There's iConnection. Yeah, there's so many things going on.
30 Real Vision events.
30 Real Vision events?
There's like 10 dinners. So what it is, it's all across South Beach in hundreds of venues with periodic group, like a big party and stuff like that. So there's people can go and have lunch with you, and then they're playing golf with OSF and Mando, and then they're going to do it's really cool. And there's none of the speakers.
Godspeed to your production team, because that sounds like a lot.
Trust me, it's going to be cool as shit. So I'll see you there.
Looking forward to it, man.
Yeah, I'll see you there, mate. So as ever, Joe brings in the goods. I just like how he thinks. I really enjoy his thought process, probably because it's similar to mine, so I can understand it. Different people come with different investing frameworks, but Joe's is pretty similar to mine. And that means that we have a commonality of language. Also in time horizon, he's not vastly different to me. I'm probably a bit longer term because he trades a bit more. He uses options, I don't. But you can see how we think through the world. And that's really important because you can't rent conviction from somebody on the internet. You have to build it. You have to build it yourself by building your own framework. Renting conviction is the way you are definitely going to lose money because you never actually believe in what you're doing. So when people say to you, you've got to believe, what that means is you need to do your homework. You need to do your framework, have an understand the technical analysis, understand where you could be wrong, understand the bigger picture framework, how the technology fits in, the adoption. Those kind of things give you a hilarious edge. It's not that complicated. So just don't fuck it up. See you next time.
Consensus Hong Kong 2025 is where the global crypto community converges to shape the next era of Web3. From February 18th through the 20th, Hong Kong becomes the meeting point for leaders across finance, technology, and digital assets. This isn't just a conference, it's where deals are made, partnerships are forged, and new opportunities emerge. Consensus features exclusive networking lounges, expert-led sessions, and invaluable insights from top industry voices. Whether you're expanding your network, building your brand, or closing your next big deal, this is the event that moves markets. Visit CoinDesk.com/consensus-HK to secure your spot and use RealVision15 for 15% off. Don't miss your chance to be part of the industry's defining moment.
Hey, thanks for sticking around to the end. Look, if you enjoyed it, hit the subscribe button and check out the video here on the right-hand side. I'm sure you'll enjoy that one as well. And if you're ready for more, go to realvision.com/join. I'll see you there.